workshops on personal finance. And so this evening, we're going to be talking about 5 investment accounts that you should know about. And before we jump into that, though, I just wanted to let everybody who is in the workshop this evening know that Lisa, our FPV case manager and coordinator of all these workshops, who just does an amazing job, has put together a survey, typically about this point in the year, before we sort of turn the corner into the fall and start looking towards the end of the year. We like to check in with you guys to just sort of see how we can better improve and specifically tailor these workshops to financial questions that you have, financial topics that are most pressing for you, that you're most interested in gaining more information on and learning more about. So just wanted to let you know that Lisa has put together a survey that she's going to post during this workshop in the chat. So in the Zoom chat, there should be a button there on your screen, on your Zoom screen, where if you click chat, where you would typically ask a question or raise your hand, she's going to post a link. You can follow that link during the workshop and just take a really brief, quick survey. It would help us out a lot in terms of gaining more information about where you're at with certain things. What are you working on? What are maybe some stresses that you have right now? Are you trying to work on debt? Are you trying to make a little bit more money because you have pressing bills? Are you trying to figure out how to save for college? What are maybe potential questions that you have and topics that you want to see us cover here by the end of the year? So just wanted to give you a heads up that Lisa is going to put the link to the survey in English in the chat. And then at some point as well this evening, she'll also put a link to the survey in Spanish, I believe, as well. Lisa, you could correct me on that if I explain that incorrectly.
No, you got it.
Okay, perfect. So I just wanted to give everybody a heads up that that's going to be there in the chat. So please, that would greatly help us out. And we do this so that we can ultimately help you. So take the survey. We take your input seriously, and we value that. So we appreciate it. So let's get into our topic for tonight. 5 investment accounts that you should know about. What I wanted to talk about this evening is that, we've talked about this over the last year or so, that there are quite a number of different ways through various accounts that we can continue to save and grow our money. And what I wanted to do tonight is highlight these investment accounts that, even if you don't utilize them, I think as part of your overall personal finance knowledge that you should know about, right? So that depending on your life situation and your longer term planning, you should at least have the education and the knowledge to know that these exist. Maybe some of you are going to be utilizing some of these already. We're going to go over those. And maybe you'll learn about a particular kind of account that you just didn't really consider using. And maybe perhaps it might give you some benefit or be advantageous for you to possibly set up in the future. If ever in the future you have questions about these accounts, we can certainly be a source of information for you. So if after the workshop you have questions, Bryan, you talked about this particular kind of account, I want to learn more about that. You can always reach out to Lisa. You can send her an email, and between the two of us, we'll be able to gather up information for you, give you resources, and answer more of your specific questions. So I'm going to talk about these 5 accounts in more sort of a broader general way. And if you have questions specific to your situation, we might be able to address some of them here in the workshop this evening. And then certainly after, you can always reach out to Lisa. So let's jump right into it. The 5 investment accounts that you should know about. 1, we've talked about this in the past. If you are not utilizing your employer retirement account, look into that. This is the year. right? Do something different. Look into what retirement benefits you have at your employer, right? So we've talked about this in a very specific session before about employer retirement benefits, but I want to remind you here, one of the investment accounts that you should know about and you should be utilizing is if you're employed at a company, a corporation, a business that offers you an employee retirement account like a 401k, okay, you should be taking advantage of that. And most of the time, you'll be quite surprised. A lot of employees don't, because when they're originally hired, they're given a benefits package, they're given the folder of all their benefits, and to be enrolled in the account, a lot of times you have to actively set that up. So you have to designate that you want the 401k account. For some employers, they automatically set it up for you, but a lot of people just don't utilize it, right? So there's a number of different benefits to an employer-sponsored retirement account, like a 401k. One is you can make contributions. And the contributions that you can make from your paycheck, right, can go in pre-tax. So you probably heard that phrase before. Money can be contributed pre-tax. What does that mean? It means that instead of being taxed and coming out of your paycheck after taxes are taken out, the money actually goes in as a contribution to your 401k and is not taxed, right? So nothing is taken from that money in terms of taxes, and it goes directly into your 401k. It's then invested. So yeah, you have to do a little bit of work. You may need to choose some investment options. And if you have questions about, Bryan, I have a 401k plan, I think I'm enrolled, I think money is going into it, I can help you figure that out. Bryan, I think I have different investment options, but I don't know if it's good for what the market is doing or my age or my risk tolerance. We can help you with that as well, right? But money goes in from your paycheck pre-tax, right? And so what that's doing as a tax benefit is it's lowering your taxable income because it goes straight from what you make and it's not taxed into your 401k. You're not reporting it as income, right? So it's lowering your taxable income. That's also a benefit. As it's invested, it grows tax deferred. So as it earns, as it grows over time and builds, it's not being taxed while it's in your 401k, right? And then when you take money out and you start making withdrawals in retirement, it's then taxable, okay? So we're taking pre-tax money, we're lowering our taxable income, it's growing tax deferred, and then when we take it out in our retirement years, then it's taxable. You can put in this year, 2021, you can contribute up to $19,500 from your earnings into a 401k. That's the maximum contributions that you can make. If you are 50 years and older, the IRS gives you an additional amount that you can also contribute to your 401k, an additional $6,500. So total, if you're 50 and older, you could put up to $25,000 into a 401k in any given year. Now, most people will tell me, Bryan, I don't make enough to put that kind of money away. That's okay. That's absolutely okay, right? What you want to be able to do, at least at bare minimum, is if you have the ability to have a 401k, be enrolled in the plan, have an account, and make some sort of payroll deduction or contribution to the account. Why? Because another big benefit of the 401k is that your employer may make a matching contribution. Sometimes employers will match up to a certain percent of what you contribute. Sometimes they will match up to a certain dollar amount of what you contribute. And some employers, not a lot, but some employers might even match dollar for dollar what you contribute. Those are few and far between. But basically, this matching benefit is the biggest reason to make sure that you at least contribute a little bit from your paycheck into the 401k, because then you're getting your company's matching contribution, whatever that amount is. By saying no to contributing to your 401k, it's like you're telling your employer, no, I don't want your matching money. I don't want it. We'd be crazy not to take them up on that offer. So you probably heard this phrase before. It's like leaving money on the table, right? It's like telling them, oh, you want to give me money? I'm going to contribute to my retirement, and you're going to give me extra money on top of what I make in my paycheck. You're going to give me extra money that's going to also go into retirement. That's like saying, no, I don't want that. So we would sort of be crazy not to do that. So even if you can contribute a minimum amount to that 401k, you may have to do a little bit of budgeting and see how much can I actually deduct from my paycheck to contribute to the 401k, right? We don't want to over contribute and then realize, oh my gosh, I got a little bit of aggressive in my contributions, and now I'm short every month on my expenses because I'm over contributing, right? So maybe start slow. Figure out what the minimum amount that you can contribute is, and still have enough money every month to meet your fixed expenses, your variable expenses, your bills, and take advantage of that employer matching. Bryan, I have no idea if my company even has this. I don't even know what the matching is. How do I figure this out? The first place to go to is to your HR department. If you have human resources, even if it's not a department, even if it's one person who's in charge of human resources, they should be able to give you information on that 401k plan. Some of you might have a portal, right? An online login where you go in and you can see your benefits, from retirement to healthcare to dental to vision. It may be all in one online website. That's another place where you can find information on your 401k. The last benefit of the 401k account is that if you change jobs, it's portable. It can go with you. So you can roll that 401k, let's say you get a new job, into the new job's 401k, and you can combine those monies. Or it's also portable in that you can roll it to an IRA. And I'm going to talk about IRA in just a second. But you can roll it to another retirement account. So you sort of take it with you, even if you change jobs, right? For those of you that work in the public sector, let's say you work in education and you're a teacher. Teachers do not have 401k accounts. That's probably because they get a pension. A pension is a different kind of retirement account. And so to save additional monies, a different kind of account that operates like a 401k is a 403b, and that's what you see there on the slide. The 403b is for public sector employees, and you can also make contributions of up to $19,500 per year, plus an additional $6,500 if you're 50 years and older, right? So it's just a different name of account, right? But it works in the same way depending on what kind of job you have. The only thing about the 403b, though, is that there is no employer matching. That's just something that you contribute to on your own, because the county, the district, whatever public sector you're in, is contributing to the pension instead of the 401k. So the 403b is an additional account that you can get, but there's no matching employer contribution. Now, some of you might say, okay, that's great. This is for W-2 wage earners, it's for employed people, but what if I'm self-employed? You can also create the equivalent of a 401k or a 403b for yourself if you are self-employed by utilizing what's called a SEP IRA. SEP, SEP IRA. That stands for Simplified Employee Pension. So it's like setting up a pension plan or a 401k for yourself. And because you're self-employed, you can actually make more contributions to it than a 401k. You can actually contribute up to $58,000 per year, depending on what you make. And so self-employed people have the ability to save in a qualified retirement account through a SEP IRA. And there's some other sort of minor provisions and policies regarding that account, but there's one 401k, 403b for employed people, and then there's a SEP IRA for self-employed people, right? And again, all these monies go in pre-tax, so it lowers your taxable income, it grows tax deferred, and then it's not taxable until retirement when you begin taking it out as income. So the employer retirement account is the first kind of account you should definitely know about. And if you don't have one, there's no better time than right now to start looking into that to see if you have access to one, to start one. If you have questions, you can always ask us. The second kind of account I want to talk about is the individual retirement account. That's the IRA, individual retirement account, IRA. There's two different kinds. You've probably heard of the traditional IRA or just the IRA, right? That is a retirement account that you could set up for yourself. So you could go online today, and there are multiple online platforms where you can open an IRA, an individual retirement account. Places like Vanguard, TD Ameritrade, Charles Schwab. These are all companies that custodian or hold your IRA and allow you to invest in your IRA. You can also even open up an IRA at your bank. So a lot of banks have IRA options as well that you could look into. You can also get an IRA through a financial advisor. So if you've ever worked with a financial advisor, or maybe you've talked with friends who work with a financial advisor, they are licensed to be able to open up an IRA for you and give you advice on the investments. So the traditional IRA allows you to contribute up to $6,000 per year. If you are 50 and older, you're allowed to contribute an extra $1,000, so a total of $7,000 if you're 50 and older. Okay, so this allows you to, again, contribute pre-tax money. It grows tax deferred, and then when you take it out in retirement, it's taxable. So if I, in 2021, contribute $5,000 to my IRA, I can then lower my taxable income by that $5,000, right? So instead of, let's say I made 100,000, let's just use even numbers for easy math. If I made 100,000 and I contribute 5,000 to my IRA, I'm only taxed on 95,000 instead of 100, right? So it's another way to lower my taxable income. Now, there's some other provisions to these accounts though that you need to know about. The IRA is meant to be a long-term investment for you to save and grow your money for retirement, right? So the IRS says, if you pull money out of an IRA before 59 and a half, so before you're 59 and a half years old, if you go, oh my gosh, I need some emergency funds, or I want to take a vacation, or whatever your reason is, if you're younger than 59 and a half, there will be a 10% IRS penalty. So if you pull money out, that money would be taxable plus that 10% IRS penalty. What they're trying to do is discourage you from ruining your long-term savings and investment in an IRA by giving you that penalty, right? So a lot of times people have good intentions. Yes, I definitely want to save for retirement. Here's another way. I'm going to open an IRA. And they start making contributions and they start investing in it. It starts growing and growing and growing. And then they'll go, oh my gosh, I really need to buy a new car. And they'll go raid their IRA to get funds. It's not meant for shorter term purchases like that. It's meant to help fund and give you income in your retirement. So the IRS discourages you from taking withdrawals from your IRA. Now, there are situations where the IRA has provisions to allow you to take monies out before 59 and a half. In the case of economic hardship, medical condition, you're hospitalized, there's a whole list of different reasons when the 10% penalty would not apply to you. So for example, during COVID, IRS said, okay, because of a pandemic and because people are in this hardship, we will not apply the 10% because of COVID. So that no longer going forward, COVID is no longer a reason, but I just give you that as an example to show that there can be ways that if in an emergency, you need to take money out of your IRA, you can do that and they will not assess the 10% penalty. If you're thinking about doing that, you should always talk to an accountant or a CPA, a certified public accountant, to make sure whether or not what you're about to do could be penalized. So that's a traditional IRA. You may have heard of a second type of IRA called a Roth IRA. In a Roth IRA, this one operates a little bit differently in that monies go in after tax. So you get paid, let's say from your paycheck, taxes were taken out, and then you decide to put money in a Roth IRA. It cannot lower your taxable income. You pay taxes on the money, you just put it in a Roth. The difference with the Roth is because you already paid the taxes on the money, it goes into the account, you invest it, it grows tax deferred, and because you paid the taxes up front, before you put the money in, when you take the money out in retirement, the money, the earnings, your contributions come out tax-free. So a lot of people use the Roth IRA so that in retirement, they have money from their IRA, from their 401k that's coming out and is going to be taxable. But the Roth IRA, that stream of income would be tax-free money, right? So that's the big sort of variation between the traditional IRA and the Roth IRA. The Roth IRA, again, the money goes in after tax. You've already paid the taxes on it. It grows tax deferred. And then when you retire and take money out after 59 and a half, it's tax-free. One last little sort of rule I want to make sure everybody knows about this account is that in the traditional IRA, the IRS says, look, we're going to penalize you if you're younger than 59 and a half and you take the money out. If you're older than 59 and a half, you can take the money out and it's just taxable. But at 72, the IRS has what they call a required minimum distribution, meaning at 72, they require you to start taking money out if you haven't already done so. Why? Remember, it's taxable. So the IRS wants to start getting their money at some point, right? So they force you or they require you starting at age 72 to start taking money out of your IRA so that they can start taxing it. So there's a lot of different benefits to these accounts, but I also wanted to sort of let you know about some of the stipulations in terms of using them, that there could be penalties if you take monies out too early. And at some point, the IRS is also going to force you to take money out because they want to tax you as well, right? So if you want to know more about how those accounts work and what might be best for your situation, again, that's another great thing that you can reach out to us about. And we can answer questions about that.
There's already a question actually in regards to the IRA.
Yeah, fantastic.
Vivian's asking, can you have can you have an IRA, Roth IRA, and a 403B account? A bit ambitious, but is it okay?
Yeah, great question. So to Vivian's question about these accounts, is it possible to have multiple accounts? Can I have a 401k? If I'm in a situation where I have a 403b, can I also have a traditional IRA? And can I also have a Roth? Yes, you can. You can have multiple variations of these accounts. For example, you could even have a 401k and you could have 10 IRAs. I wouldn't suggest that at all. That's just too many accounts to manage, right? But you can have multiple accounts. However, the catch here is that the contribution total of $6,000 to an IRA or $7,000 if you're 50 and older per year is total. So whether you have one IRA or whether you had 10 IRAs, the total amount that you can contribute to the one or in total to 10 is that 6,000 or that 7,000 limit. So you can't do 6,000 to one IRA, 6,000 to another IRA, 6,000 to another. No, it's 6,000 total, right? And that is sort of the biggest downside to the IRA, is that the contribution limits are fairly low. And that's the total for the year. So you couldn't sock away in 1 year $10,000. It already exceeds the limit. And I couldn't do 3 IRAs with $6,000 each. It's 6,000 total. Yeah. So great question. You can have multiple accounts. Absolutely. People do this all the time. But the contribution limits are limited to a total annual contribution. Yeah. Great question. Third type of account. Yeah,
sorry
go
about
ahead,
that.
Lisa.
There was one more question before that.
Yeah.
Rosemary was asking in regards to the 401k. If you aren't sure you have a 401k, would there be any information on your pay stub, like a code?
Yes. If and this happens a lot. So this is a great question. Unbeknownst to a lot of employees, when they were hired and when they first got their benefits and were enrolled, they may have a 401k plan. And they've been so busy, it's sort of like out of sight, out of mind. They don't even know. Yes, look at your pay stub deductions and see if there is a line item where they are taking money from your overall paycheck that is not going to federal income tax, state income tax, or is not going to like Social Security or, some other tax. It could be labeled as 401k. It could be labeled as employer retirement benefit. Like, it could be called something, right? But look and see if there might be that deduction. Okay. If you don't see anything, then that's sort of, a flag to say, well, maybe I don't have one. But yeah, definitely the pay stub or your pay statement is the first place to maybe sort of see, wait, am I making contributions from my paycheck every month? Then the second place would be, again, your human resources contact or your human resources department. Lisa, I just want to check in with you. Were there any other questions regarding 401ks or IRAs? Okay, no, great. Let's talk about the third kind of account then. The third type of account that you should know about if you have kids is a 529 college savings plan. This is not only a savings tool for college, but it's also a savings and investment tool. Just like the IRA is for retirement, just like the 401k is for retirement, you can also save and invest monies for college. So if you have kids who you believe are going to go on to higher education, going to go on to college, maybe they're even going to go on to vocational school. Maybe they're going to go to a private 4-year university, a community college. Maybe they're going to go get a master's. Maybe They have aspirations to go to medical school. A 529 college savings plan is a great way to begin getting tax benefits for saving for college. So the way that the 529 college savings plan works is, well, let me just say this real quick. 529 in the name just simply refers to the tax code, and it's just named after this college savings benefit 529 in the IRS tax code. So the 529 college savings plan is an account that every one of our 50 states has a college savings plan. So California has one 529 plan. Colorado, one 529 plan. Washington, Oregon, Texas, you get the idea, right? So there are 50 different 529 college savings plans. Why they did it this way, I don't exactly know the history behind that, but there is one available plan per state. Just because you live in California doesn't mean that you have to use the California plan. You could get the Texas plan if you wanted to. If you felt like the investment options were better in that plan, it was more flexible, there were lower minimums, the fees were lower. I mean, you could do a little bit of research. So there's one plan per state. You can get an account from any state. Some states have, depending on where you live, it may be beneficial to use that state's plan or account because you could get tax benefits for your contributions, like you could write off your contributions. California's does not have a contribution tax deduction. So what you put into it, it's just going to be after tax money. You can't write it off. Okay. But you put money in after tax, it's invested. It's not meant to be risky, right? Because we don't want to risk dollars that we're saving for our kids' education. So they're not overly risky. But in the same way, because it's not overly risky, it's meant to grow conservatively, right? But you can try to grow those monies. It will grow tax deferred. And then the big benefit is when your child is ready to go to college and you need to pay for qualified college expenses. So tuition, fees, room and board, right? If they're going to live on campus. 529 plan funds can be taken out tax-free. Okay. Here's a couple of little sort of policies that you may want to know about. Bryan, what if I have multiple kids and I open a 529 college savings plan for my oldest and they decide they don't want to go to college? 529 college savings plans allow you to roll funds between your kids. So if your first one doesn't end up going to college, you can roll what you saved for that child into another child's 529 plan. So there's some flexibility there. But the big question that a lot of parents ask is, what if I want to use it for something different? What if my oldest doesn't go to college? I don't have any more kids, right? And now we just want to use the funds for something non-school related. Maybe they want to start a business and we want to help them with that. Or maybe they're not going to go to college and I don't know, they want to get married. Can we use it for the wedding? Okay, just like the IRA, where if you pull funds out before 59 and a half, there was that 10% penalty. Same thing applies here for 529 plans. If you do not use the funds for qualified college expenses, there is a 10% penalty. Okay. And then the monies do not come out tax-free. You'll be taxed on the money and you'll pay that 10% penalty as well. So you should know that they're really sort of built for investing long-term, saving long-term, and using the funds for college. That's the main reason for that tax benefit of using it tax-free is because you're going to use it for college. So the IRS discourages us from using this kind of vehicle if we're ultimately not going to use the funds for college. It'll be taxable and there'll be a 10% IRS penalty. Okay. So college savings plan account might be a good idea if you have younger children. You need a long enough time horizon or a long enough period of time to have the money be in the account, growing, invested over time, right? But it's a great way to start a bucket of money for your kids' long-term education. So normally what I hear from a lot of parents is, oh my gosh, when we had our kids, I mean, we intended to save for college and school and life gets in the way. And then they started growing up so fast. And now here we are, they're in high school and we have nothing saved for college. Probably not a good time to start a 529 college savings plan once they're in high school. But if you have younger children, elementary school age, toddlers, this is a perfect opportunity to open a 529 college savings plan. Here's what I recommend is that in all of these upcoming birthdays, Christmases, quinceañeras, all this stuff that's going to be coming up, right? Where your kids are going to be gifted money. Having a 529 college savings plan is a great place to put that money, right? Yeah, of course, we want to be able to give them some money. They can buy some stuff and have gifts from grandma and grandpa and so on, right? But this is also a great way for you to tell people, look, we have enough toys, or we have enough strollers, or we have enough whatever for the clothes for them. We'd love to save for college. So you can take a lot of those cash gifts and just put it right into a 529 plan. So if you're starting out early, take a look at a 529 college savings plan. This will be a great way for you to jumpstart that saving long-term for college. And also too, maybe give you a reason to systematically and habitually save for school, right? So that's the third type of account I wanted you to know about. The fourth one is one that a lot of people have questions on because it's not used as much. And that's the HSA, the health savings account. So a health savings account is a way that we can pay for qualified medical expenses with tax-free money. Again, another IRS benefit to an HSA. So we can deduct our contributions from our taxes, so it'll lower our taxable income, right? We can withdraw, like I just mentioned, we can withdraw the money and use it for qualified medical expenses tax-free, and it grows in the account to cover your medical expenses tax deferred, right? So a lot of people ask, well, then wait, why does this account exist? Why would I need an HSA if I have health insurance that covers my medical costs? Well, as you probably know, a lot of possible procedures, services, healthcare services that you need are not always entirely covered 100% under your employer's medical plan, your own, maybe you're self-employed and you had to purchase healthcare, through Cover California. A lot of these health insurance plans don't cover all of our expenses. And so whether it's prescription drugs, whether it's doctor's visits, we're having to pay out of pocket. And oftentimes our health insurance plans have high deductibles, right? Meaning that the insurance company does not pay out until you reach a certain amount that you've paid out of pocket, a certain deductible. And to lower our monthly health insurance costs, we say, well, I'm willing to take the risk that I'll stay healthy and I'll just go with a high deductible. An HSA account is a great way, if you do have a high deductible plan, to cover some of your medical expenses. So you can make contributions to it, right? With pre-tax money, it grows tax deferred. And when you use it for medical expenses, it comes out tax-free. So those benefits are hard to ignore. Right now, as an individual, you can contribute up to $3,600 a year into an HSA. If you have a family with dependents, you can contribute up to double that, $7,200 a year. What's really nice about the HSA is if you do not use those funds, the funds roll over into next year. So it just keeps building, 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 and you can just tap into it and use it for medical expenses as you need it, right? So some people say, well, okay, that's an HSA, but I've also, Brian, I've heard of an FSA. An FSA is similar. It's a flexible spending account. A flexible spending account allows you to make contributions, but you cannot roll over the entire amount if you don't use it. So typically an FSA is used in an employer benefits package. So maybe they give you a 401k. Maybe they have some dental and some vision. And then maybe they even offer an FSA where, depending on the arrangement, the company might make contributions to your FSA. You would have to look at the details of your company's FSA. Ask your employer about that. In the FSA, you can contribute up to $2,750 per year, but only $550 can be carried over into the next year. So basically, you use it or you lose it. So all of it has to be used, but $550, that can be rolled over into the next year. So that's sort of the big difference between the two types of plans. Is the HSA, as you contribute each year, it can roll over if you don't use it, and it can build and build and build, right? It can lower your taxable income. It can be used tax-free for medical expenses. FSA has a lower contribution amount, and you got to use it, all but $550 per year. So if you've run into a situation where, gosh, you know, I have healthcare, I have coverage, but it's not, I am having health issues, or I'm routinely and regularly needing, you know, ongoing, you know, doctor's visits or labs. I need to do tests. I need prescription medication because of issues that you're having. And you're having to constantly pay out of pocket for things. Perhaps looking into an HSA might be a good idea, because you can contribute to it, can lower your taxable income. You can still try to grow the money, and it can roll over from year to year based on what you use and what you don't use. So that's a good fourth type of account to look into. The last type of account is the brokerage account, which is, Brian, how could I just invest? I don't want to invest for retirement. I'm saving at my bank. I don't need the healthcare account. Don't need a 529 plan. How else could I invest my money? You could simply open what's called a brokerage account. There's no tax benefits to this kind of account. It's basically a stripped down investment account. You can open one online with an investment broker like a Vanguard, like a Schwab, like a TD Ameritrade. And you can invest in stocks, bonds, mutual funds, Bitcoin. We talked about the future of money last time, and cryptocurrencies and so on. A brokerage account just simply allows you to invest. So the money that you put in there, it's after tax. It already came out of your paycheck. Taxes already came out of your paycheck. And now you're just taking some of your income and you're investing it. Okay. It can grow tax deferred, but when you sell, you'll have to pay taxes on the earnings. They call it capital gains. So depending on how long you've held those investments, it could be short-term capital gains, it could be long-term capital gains. But basically, once you start buying and then you start selling, then those sales will generate taxable income, right? So there's really no tax advantages to this. It's just another opportunity for you to grow your money, okay? I think I see somebody raising their hand that has a question.
Yes.
Yeah, so my question is, what if you sell, like, what if when you sell, you sell at a loss? Do you still have to pay that tax?
Great question. Love that question. What if, Brian, we're in a situation where the market takes a downturn, I sell and I sell at a loss. I haven't made any money. Okay, so what, obviously, you didn't make any money, so you're not paying taxes on that. But there is a tax provision that says you can write off losses. So you could take your losses and apply that up to $3,000 of losses per tax year, right? That you can help lower your tax bill, right? So what you would want to do is, if you sell and you sell at a loss, you're going to report that loss in your taxes, or you're going to report that loss to your tax accountant, your CPA, and they're going to offset your taxes with that loss. So there is that provision where the IRS says, okay, we sort of feel bad for you. You know, you took a loss, you're able to write that off on your taxes. So sorry you had to have a loss, but there is a little bit of benefit to that. And so in some situations, people will actually strategically sell their investments at a loss so that they can then write it off in their taxes. Yeah, that's a great question. But beyond that, I would definitely say, for your specific situation, if you have a loss, always be sure to talk to your accountant, your CPA on that, or if it's H&R Block or whoever is doing your taxes, let them know, hey, I sold some investments. That should be a standard question that they ask if you sold any investments. And yes, I sold at a loss. And you want to make sure that you show that on your taxes, because that can help you. Yeah, great question.
Okay, because I've been filing my own taxes for the past 3 years, but this last year I didn't file because now I have my investments as far as my stocks, and I didn't know how to file with that. And then with everything with the COVID, it kind of just made it a little bit tricky on top of that. So I just didn't file taxes this year because I didn't know how, and I don't have a tax accountant.
Yeah, and you know, in general, if you are a person who is doing your own taxes, and maybe perhaps you're using tax software, whether it's TurboTax or any of the tax software out there, there will be a section as you walk through your taxes step by step where it should address for you any sales of investments. And also, to add on to that as well, if you do your own taxes, it will also ask you if you made contributions to IRAs. It will also ask you if you made contributions to 401ks, right? So if you're using tax software, that will be in that software somewhere. If you're sort of walking through each section, you know, step by step by step, that question should come up. So it's definitely not something to be afraid of, even if you're doing it on your own. Yeah, that was a great question. So those are the 5 accounts that I just wanted to sort of go over that you should have on your mind. You don't need all of them, and that's not what I'm saying, but I just wanted to sort of expose those 5 accounts that you could be using in some way, shape, or form, depending on your situation. If you have questions about these accounts and you want to get more information, like I said before, reach out to Lisa, email her, call her, leave a voicemail, talk to her. If she can't get you the info, she'll reach out to me and I'll definitely get you the info, or I'll get in touch with you to explain it. My next workshop is 2 weeks from now. We're going to talk about the 7 purchases that are worth the money. And I'm not talking about little everyday kind of purchases, but really walking through what are sort of the big life purchases that can be worth the money. That's going to be on Thursday, August 19th, same time again, 6 p.m. I appreciate everybody being here on an evening after a long day of work. Maybe you're trying to get home, you're trying to fix dinner. I appreciate everybody being here. Lisa, let's just circle back and see if there's any additional questions. And then one more time, we'll just make sure that everybody knows about the survey as well.
Yes, so we don't have any other questions. The only other question is, if they can get the recording of the video. And of course, you can get the recording. We usually post it up on YouTube. And our YouTube channel is FP Verdugos. And I just put that, oh, sorry, I mistyped it. But yeah, I can send you guys the link if you guys need to get access to that. And I only got 1 response from the survey. So if you guys want to take a moment before we finish up and just take a few minutes to do the survey and just write done at the end in the chat once you guys are finished. And a little bit of an announcement for next week. We have Burbank Temporary Aid Center is going to be presenting, and they're going to be talking about their food pantry services and other services like utility assistance that they offer. So if you guys are interested in that, I highly urge you guys to attend that workshop as well. And it will also take place on Thursday. It will be August 12th at 6 p.m. Okay.
So you can find a link to the surveys in the chat. Lisa put those up in there earlier, so you may have to scroll a little bit. But yeah, you could find those surveys. And just to make sure that, I said this correctly in the beginning, Lisa, there is one in Spanish.
Yes, también tenemos una encuesta en español para la persona que está ahí esperando en español o escuchando en español que diga. Si puede hacer favor de llenar esta encuesta. La primera no. Ahorita la que acabo de poner es en inglés. La que sigue es en español.
Yep. So both of those links should be in the chat. Like I said at the very beginning of the workshop, it would really help us out a lot if you could complete a survey. Just let us know, in your financial situation, your household, maybe in your personal finances, what are you working on? What are some topics that you would like us to cover, get more information on? We want to make sure that we're able to specifically tailor these workshops to what are sort of on people's minds right now. So yeah, if you would take a moment to complete the survey, it's not long at all, we would greatly appreciate it. Okay. And so with that, as you finish that, I just again want to thank everybody for being here this evening and taking the time to ask great questions and to talk about, personal finance topics that are just going to keep helping us get better and better at managing our money.
All right, I'm going to stop recording now.
Okay.